relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 45 long years, you'll remember it's been our family's mission to deliver you clarity and confidence to help secure your financial future. Welcome back to the show. It is indeed the mid-year outlook show to tell you where we think markets are headed the rest of 2026. And I've got a great chart to show you in the second half of the show here of where we think mathematically, statistically, we think markets are headed. So don't go away. Before we jump into it, Tom Lee is coming to Investor Day. Don't forget to register. And last week after the show, we got a ton of registrations, and we are getting very close to max capacity. Don't forget to sign up. It's going to be on the description on YouTube. Tom Lee, Investor Day, right here in the suburbs of Chicago. It's going to be a very nice time of year. You're thinking to yourself, Nick, why would I want to come to Chicago when it's October? Well, October is actually one of the best months. It's not that cold yet, not too hot. It's starting to get into fall. It's a very nice time, so don't miss it. Tom Lee Investor Day 2026 coming up right around the corner here. We're going to jump into episode 224 today, the mid-year outlook. I'm going to tell you my S&P target, and I am raising my target for the rest of 2026, which we have not done in a while. We've never haven't done a mid-year raise in a while, but I do think we are due for that, and I do think the S&P is headed higher. I'm going to talk about it, but if we could start with the first chart here today to show you where we've been in the past performance, no guarantee of future results, but just showing you where we've been at Stenger Family Office, our predictions for the S&P at the end of the year. All the way back to 2023 now, we thought S&P would be 4,300. It was 4,800. 2024, we said 5,200. S&P was 5,881. We've been pretty conservative. Not to say that we nailed it to the point, but the point is we've been directionally correct. Now, it looks easy in hindsight to have made these calls. It was not easy in reality. Each one of those times throughout the past 4 or 5 years now, people have been calling for doom and gloom, panicking, telling people to get off their plans and not stay invested in the market, to buy bonds and cash and gold bars, run for the hills, build a bunker in your backyard, and fill it with MREs, meals ready to eat. We told you to do the opposite. Despite all the doom and gloom media that said to do that, to panic and jump ship, we said to stay on your plan. Again, sounds easy in hindsight. It was not easy at the time. Every single one of those times, there were 10, 12, 15 reasons a year to get off. And so because you've been coming back to the show each and every week, hopefully you've been seeing the clarity and confidence, the good news that you need, the reasons to stay on your plan. We said 7722 would be our target for the S&P at the end of this year. And here we are today. S&P's about 7,500 points almost again. The peak was 7,600, within 100 points or so of our target. Happened a little bit more quickly than it probably should have. But at the same time, the earnings growth has been off the charts. We've seen earnings with S&P companies just at record all-time highs. We thought that 10, 12 earnings percent growth would be huge for the first quarter. It was actually 26%, the highest level it's been at for about 3 years now, 4 years. So even after setting these record all-time highs, after the S&P climbed from about 3,000 points a few years ago during COVID, before COVID, to today, despite all the growth, despite over 100% gains in the market the past couple years, the S&P is still posting record earnings growth, and that's what's supporting the bull market that we're in. It's not a fugazi, it's not a woozy-wazy, it's not built on a fantasy, it's not fake. It's built on the reality of earnings. Now, let me show you this next chart here as we get into it, but pre-COVID, the S&P was about 3,300 points, almost 3,400 points, and then you had COVID. Remember, 2 weeks to slow the spread turned into 2 years to slow the spread. Spread never slowed. We reopened. Economy's back, bigger and badder than ever before. But in that moment, people said that we would never go back to normal. Think about that narrative. Now, people today say, Nick, that's not real. That's not true. We all knew we'd go back to normal. Not if you listen to our clients back then. Not if you listen to the media, if you listen to the narrative. We told you the opposite. We said, stop listening to the narrative. Get your hands on the data. Don't just expose your face to it, but really get into it. And what did the data show? We were going to be okay. It was going to bounce back. So we had a 33% pullback during COVID. That's a significant pullback. And by the way, if you get something like that today, you're dropping a couple thousand points on the S&P. It's a scary, scary drop. That could happen if we have a big black swan event. However, market recovered its losses in a few months, and the COVID year, 2020, we posted a positive return on the S&P. Now let's zoom in here for a second. Let's talk about Fed rate hikes for a second. Market's chugging along. We hit 47.91 at the end of 2021. December of 2021, we have a brand new all-time high in the market. Fed says, wait a second, we're late to the game. Turns out inflation indeed is not transitory. We've got to panic and start raising rates. Market hated it. Remember, don't fight the Fed. We told you we're going to be going through this thing called the wilderness for a little bit. Sure enough, Fed starts hiking rates, its highest, fastest pace on record since the 1970s. We went from 0 to 5.5% in a matter of a year and a half. The market dropped 25% in 2022. Let's go back to that chart here for just a second. Look at that drop. 25% drop when the Fed started hiking rates, but what happens? Market climbs the wall of worry. We keep going. We make a brand new all-time record high. This is now March of 2025, so figure about 2.5, 3 years after we get through this last drop, we have Liberation Day, and all of a sudden market drops again. 19% drop in the S&P, but what happens? Market recovers its losses. Look how quick this happens. Tom Lee pointed out the fact that every single waterfall correction, when you fall quickly, look at that. That's a waterfall, Liberation Day. Every single one has been followed by a V-shaped recovery. Does that not look like a V-shaped recovery to you? To me, it does. And then what do we have? Let's zoom back out here. The Iran conflict. We get to 69.70, almost 7,000 points on the S&P. Don't quite hit it. There's another waterfall correction. Every single waterfall correction followed by what? A V-shaped recovery. Now, in hindsight, let's zoom back out for a second. This line seems very easy to navigate. It seems like it's so easy to stay on your plan. Oh, of course the market's going to go back up. It was not easy, and I got more and more calls. It was almost like people had treated Iran worse than COVID. They were treating every single subsequent doom and gloom event like it was worse than the one before it, even though the ones before it were the worst. COVID was the worst. We shut down the world. We shut down the global economy. We pumped trillions of dollars of stimulus in. That's why we got all the run-up in inflation. We got 45% more dollars in the economy. And people were treating the Iran conflict like it was worse than that. I mean, you've got to use some common sense. You've got to look at data. And if you can't do it, you better come back to the show and have somebody who's going to keep you on your plan. Because I'm telling you what's coming next is there's going to be 2, 3, 4, 5, 6 more black swan doom and gloom events. And each one of them is going to be a reason to panic and get off your plan. I don't know what it's going to be. We're going to talk about the SaaS apocalypse here in a second. But all that to say, you are going to see more doom and gloom. It's up to you to decide if you're going to stay on your plan. Let's talk about our year-to-date market scorecard, if we could get that on the screen here. A lot of numbers, but all that to show you that, yes, small cap and mid cap, which I'll show you in a second, are leading the charge. But the S&P, other than Japan, U.S. equities are leading the charge. I had a bunch of people who I'm still waiting for an apology from tell me, Nick, why didn't you get me into Europe? Why didn't you get me into all these different asset classes, international? I said, just wait. Wait for the currency to switch. When in doubt, zoom out. Look at China here. You want to be in China? You'd be down 14% year-to-date on China, 5% the past 12 months. You are still negative on China. Look at that 5-year number. Negative on China the past 5 years. You have not made money. Look at Europe, 8%, almost half of the S&P. The top 50 of the S&P, you're at 14% a year. On the 10-year, you're at 17% a year. On the top 50, it's been the number one place to be. Look at those treasury returns. Horrible. You're actually worse off in treasuries in 20 years than any other asset class on the screen. That's why we said keep your bond allocation short term. Don't go risk it on your safe money. Gold and silver. Gold's up. It's up on the 5-year. It's actually the number one asset class on the 5-year number. But look at this year. It's down. On the 10-year, it's almost, not quite, but about half of the top 50. So when in doubt, zoom out. People all the time say to me, they go, Nick, look at this asset class. It's doing so well this year. Why aren't we in it? Please tell me you're not chasing asset class returns. Please tell me you're not just chasing the numbers from last year. If you're doing that, you're not on a plan. I told you I'd show you large cap, mid cap, small cap. If we can get this up on the screen here. Large cap up 8% this year. Look at mid cap and smalls doing well, but zoom out to the 5 and the 10. Large cap still winning. Now, all that being said, within the large cap, and you have to remember when you talk about the S&P being at record all-time highs, not every company in the S&P is doing well right now. So I put this list together of the large cap Hall of Shame. Year-to-date returns on some of the worst-performing stocks in the index, Intuit down 62%, Accenture down 53%, the consulting company, Adobe down 45%, Salesforce down 43%, ServiceNow down 39%, Palantir down 39%, Microsoft down 27%, Oracle down 22%, Netflix down 20%, Meta down 16%. Not saying you should buy these stocks, but what I am saying is not all of the S&P is at an all-time high. So when you're just going out and buying the index, not really paying attention to the companies you're buying, you have no control over the actual holdings that you own. And so that's why we like having the stocks. We like the ability to rotate and be able to take some profit on the stocks that are doing well and are up and reinvest in some of the companies that have had their valuations cut. I'm going to show you why that is here on the next couple slides, but let's look specifically at the SaaSpocalypse. This is all the software as a service companies, if we could get this on the screen here, that are down. I'm going to show you Intuit again, but look at HubSpot here. HubSpot's revenues have been growing 20% a year for the past 5, 6, 7 years. The stock's down 55%. You can buy HubSpot today like a value stock. I'm not saying you should buy it or anything. I'm just showing you what the market is doing. Workday down 46%. Adobe trading for 10 times earnings, down 45%. Salesforce trading for 10 times earnings, down 43%. ServiceNow down 39%. Palantir, all of these are real businesses, by the way. They're all doing real things. I'm not saying they're all going to go right back up, but what I am showing you is that the narrative has shifted so heavily, and it's turned software stocks into this just absolute pariah that nobody wants to touch. And I would equate that to this headline that we saw. This is December 2022. As we get into these apocalypse-type headlines and then some of the industries that go down with these headlines, look at Reuters here, December 30th, 2022. Wall Street ends 2022 with the biggest annual drop since 2008. You have to understand, these drops we're seeing in software stocks today are not new. This is not a new thing. In fact, if we zoom in here to 2022, here's my next slide for you. Let's talk about what happened when the Fed raised rates the last time, because that's really what's happening. We went from this narrative with the Fed that we were going to get rate cuts, and now we're shifting to actually a rate hike in December. So we're going to ask the question throughout the rest of the show today, do we think that we're going to have a massive drop in the market because we're going to hike rates, or are we just going into some wilderness here? So let me show you 2022. This is what happened when the Fed started raising rates. Remember, don't fight the Fed. Coinbase was down 89%. If you bought it back then, you're now up 300%. Tesla was down 72%. If you bought it back then in 2022, you're up 230%. AMD was down 64%. Yes, if you bought it back then, today you're now up 837%. NVIDIA down 62% back then. Today it's up almost 1,500%. These are price returns only, not including any dividends if they pay them. Amazon down 55%. Yes, a company like Amazon was down 55%. If you bought it, you're up 167. There's Google. Everybody remembers the Google story, down 41%. If you bought it, you're up 283. Did you really think Google was going out of business? So use some critical thinking here on these investments. I want to equate that to what happened in 2020 with the oil market and the narrative that happened there. Remember, oil companies during 2020 were paying to hold inventory on their balance sheets. Not good. And so when you're holding inventory on your balance sheet and you can't sell it and you're paying money to do so, you're losing billions and billions and billions of dollars. It was a narrative at the time that oil companies were going to go out of business. And I'll just remind you of this. It was so severe that the Dow Jones Index, it's a committee of people that vote on what's going in the Dow Top 30, the Dow Jones voted to boot Exxon out of the index out at lows, at an all-time low, less than $30 a share, thinking it was going to zero. And they replaced it with Salesforce.com at 1,800 times earnings. Well, the narrative has completely shifted. It was a horrible move that they did. They sold Exxon at the low. They bought Salesforce at the high. Salesforce is down a bunch. Exxon's up a bunch. But here's what happened in 2020. Back then, in 2020, Exxon was down 52%. The narrative was literally that Exxon was going to go bankrupt. If you bought it, you are now up 315%. Conoco, down 51, up 141. Chevron, down 40. Up 222. Be careful of the narrative. If you bought that narrative and you sold your Exxon stock at $28 a share, look at what you're missing out on today. So I would argue that a lot of these companies that you're seeing right now, the SaaSpocalypse companies, I think could be very similar. I'm not telling you investment advice. This is just for fun. This is just entertainment. This show is not investment advice, so there's your disclaimer. But all that being said, I see similarities today to what happened back in 2020 with the oil market. Now, here's another market that was very similar, another apocalypse. 2008, remember the financial crisis, Citigroup was down 95%. Yes, 95%. You lost basically all your money. But if you bought Citigroup in 08 and 09, you're up 410 today. Bank of America, same story, you're up 1,400%. Yes, those are real numbers, not including dividends, on B of A and Morgan Stanley, JP Morgan. So just be careful before you buy the narrative. The narrative isn't always right. Now, you may be asking yourself, well, Nick, how do I know which companies to buy back then? You don't always know. You don't know which ones are going to make it. But I would argue that more of them are going to make it than you realize if you look at fundamentals. I would also argue that the 08 financial crisis and the 2020 oil crisis were much more severe than the crises we're facing today with software and big tech. Big tech and software still have billions and billions and billions of dollars of reoccurring revenue. And if you think, again, not investment recommendation, I'm not telling you to go buy it, but I would guess Accenture, for example, is not going to go bankrupt. I would guess Adobe, which is growing 20% a year, is not going bankrupt. Maybe they have a slow decline, and that's what the market's pricing in. But just to say, fundamentally speaking, these companies are not sitting on a massive problem like we did in 08 and 09 with the banks. And so you were better off today with the narrative than you were in 08 and 09. You're better off today with the current narrative on software as you were better than today than you would have been in 2020 with the oil market. So the narrative always feels bad in the moment. You have to be able to zoom out. Now, here's Peter Lynch. Interesting quote, interesting stat. The average stock swings 100% per year. It could go down 50%, up 50%. That's the average stock. That's just data that they put together at Fidelity. This is real. The average stock swings 100%. Think about what that means. A stock could be down 50%. It could go up 50%. You could still be down on it. But think about the amount of volatility you've got to live with as an investor. And this is what we keep telling you. The reality of being an investor in equities is that you've got to be able to deal with swings in the market. You've got to be able to deal with ups and downs. You've got to be able to deal with down 70% sometimes. You got to be able to deal with down 40, 50, 60%. You have to be able to stomach the volatility. And it's coming. That volatility is coming. We are still getting into the early innings of the midterm elections, and we're going to get to that in just a minute here, but we are not out of the woods on the volatility we're facing today. We were at 7,600 at the peak on the S&P. Now we're down to 73, 7,400, bouncing back up a little bit, but we're still going to have some choppiness until we get past the midterms. That's just statistically what happens. So here's what I want you to remember as we go through some more volatility, if it should come. Think about the fundamentals. Here's Microsoft today, doing $332 billion of annual revenue, more than the GDP of a lot of countries. $128 billion of profit. Microsoft now is trading cheaper than Costco. It's trading cheaper than Casey's General Stores. It's trading cheaper than, yes, Procter & Gamble that's making toothpaste. It's trading cheaper than Johnson & Johnson. It's trading cheaper than most companies in the S&P. The average PE in the S&P today is about 23, 22. And then I go forward, it's about 20. Microsoft is cheaper than a lot of these companies. Think about this before you panic. 450 million customers. Record Azure revenue at Microsoft. Let's talk Meta. Number 2, $224 billion of annual revenue, 3.56 billion people on its platform, active daily people. That's like half of the world. Name another company that has half of the world as its customers, and you're going to sell that stock? Really? Absolutely unbelievable. Let's talk Adobe here, and I'm not saying to go buy Adobe. More pain could be ahead for Adobe. Let's look at the fundamentals, though. Look at these revenue numbers. 2019 through 2026, doubled revenue. Now, I would argue some of the pullback you're seeing, some of the slowing growth at Adobe in the past 2 or 3 years is just attributed to the fact that look at how much they grew so quickly. From 2019 to 2022, they went from $11 billion in revenue to $18 billion almost. No question they're going to slow a little bit. But you're going to toss the baby out with the bathwater on this one? You're going to toss out the fact that this company does $26 billion in revenue? It's a real business. It's not a fugazi. Now, we don't own it across the board for Stenger Family Office clients, but we're going to look at stocks like this. I think it's a little early in some cases, but we're going to look at stuff like this because these are the times where people make money. You make most of your money in a bear market, even though you don't realize it at the time. Davis Advisors. But you have to understand that the narrative is going to get worse sometimes before it gets better. And it's right when the narrative gets so bad. It's over. Throw in the towel. It's all done. It's all done for ExxonMobil like it was in 2020. It's all done for Chevron. It's all over for the banks in 08 and 09. It's all done for any restaurant business during COVID in 2020. Really? When in doubt, zoom out. Look at the fundamentals. Salesforce, here's another one. Again, not owned across the board at Stenger Family Office, but we're looking at it. 2019, $13 billion of revenue. Today, $44 billion. You're telling me that this isn't a real business? Trading for 10 times price to earnings? Here's Accenture, $43 billion to $75 billion. So all that being said, I just want to tell you one other thing here to think about, which is don't fight the Fed. Why? Because all of this is true. All the fundamentals are true. All the fundamentals could be intact in the market, but at the same time, if you start fighting the Fed, you're going to have a tough time with returns. And I've told you this before, we discount stock prices by the Fed's interest rates. We discount the future by today's interest. Why? And this is how this actually works. So remember the stock price formula, okay? And if we could throw this back on the screen, remember it's a very easy formula that I've told you time and time again on the show, earnings times price, E times P. That's as simple as how you get a stock's price. So if you take a company that's doing $10 in earnings and it's trading at 10 times forward P, what's the stock worth? What do you buy the stock for? $100 a share. Very easy, very obvious. If the stock gets more valuable and they grow the earnings faster, let's say the earnings are now $15, trading for the same P, 15 times 10 is $150 per share. But here's the reality. If we could put this back up, please. PE multiples, that 10 PE, is discounted by prevailing interest rates. So the $10 in earnings may not change. It may not go up a lot, it may not go down. And in fact, the business underlying fundamentals might be quite good. But the valuation that you pay for a stock price, the reason you're seeing compression temporarily in Microsoft's PE multiple, for example, is due to the Fed. It's due to interest rates. If we thought we were going to get these massive rate cuts, and we were going to go back to COVID and we're going to have a 0.5% interest rates, yeah, all these tech companies through the roof. But the fact that we're going to get potentially a hike, which I don't know if I necessarily believe that or not. I think Warsh might just be saying that so he can get the job, and then he's not going to hike rates in December. But the fact that the market thinks that right now, that is priced into the FOMC right now. The fact that the market thinks we're going to get rate hikes and rates are going to be higher for longer and all the rest of it, it just makes people pause for a second on that valuation piece. So let's get this back on the screen for just a minute. Remember, this multiple here is discounted by interest rates. This is going to be very important in this next example I'm going to give you. This is not a real company, but I want to show you the factors, the math that goes into why these stock prices fluctuate over time. You've got a couple things here. You've got earnings. You've got the stock price that you're paying, the actual price that you pay when you go into your Schwab account or brokerage account or wherever. This is the stock price. So, if NVIDIA is trading at $200 a share, that's the stock price. You've got earnings yield. All you're doing with earnings yield is taking the profits the company made, earnings, you're dividing it into the stock price. That's the reverse of the PE ratio. And what you come up with is earnings yield. And that's very important because we like to compare earnings yield to the 10-year Treasury yield. Why? Because remember, we don't buy stock prices in a vacuum. You buy stock prices relative to other asset class options. And so as we put this together, let me show you. This is, again, just made up example, but this is typically how this works. Let's say in the first year, the company's doing $10 in earnings. They're doing pretty good. The stock price is about $100. So again, 10 times earnings, pretty reasonable, value-oriented company, value stock. And remember, you take that earnings yield and you say $10 into 100 is a 10% earnings yield. That's a very high earnings yield. There's some companies out there today like Capital One and some other banks and some other businesses that are trading close to a 10% earnings yield. Well, if you compare that to the S&P, The S&P today is trading about a 4% earnings yield, maybe 4.5%. That's actually pretty good. For example, Microsoft today is trading about 5.25% earnings yield. Not bad for a growing business. You compare that to the 10-year. Now, in year one, this might have been a year like 2023, for example, right before we started to really digest some of these interest rates. 10-year in that 3-4% zone. You buy a company with a 10% earnings yield, you're like, hey, this is pretty good. Now, not just in a vacuum, you want to look at forward earnings yields, not just backwards looking. But if you're buying a stock at a 10% earnings yield and the 10-year is 3%, that's not bad. That's pretty good. That's a pretty good value. So now let's go to year two. So here's year two. Earnings go up to 12. You have a pretty good jump on profitability in this company. And let's say investors value the stock now on a PE basis even higher. So not only did the company do well fundamentally, that's what you're really looking for when you buy businesses, but investors also value the company at a higher valuation, a higher PE, which sends earnings yield down to 8%. So your earnings yield is still really strong, but because the stock price is up so much, the earnings yield is starting to come a little bit closer to where that 10-year is. In this example, I said the 10-year went up. It went up to 4%. So again, you're still buying this company at a really, really reasonable value. Here's year three. Company fundamentally does well. It goes to 15 times earnings. Stock price jumps way up. Investors love it. It's at $250. It's up 2.5 times more than what you bought it a couple years ago. This does happen all the time in the market. But now your earnings yield has dropped, for example, to 6%. And the 10-year is now at 5%. And this is very similar to what happened in 2021 when the Fed started raising rates at the end of the year. People started to re-rate the valuations that they were placing on stocks because there was another alternative. That whole acronym of TINA, there is no alternative, went away. You know, the fact that you'd buy a stock at a 4% earnings yield didn't really matter because you'd have the 10-year at 0, so stocks were the only place you could go. Well, that ended when the 10-year went to 5%. Certainly even at 4.5, people started questioning what's the right earnings yield on stocks. Now let's go to year 4 here because this is the correction year. And this is really important to understand that the company still in this case could grow earnings, fundamentally do well. This means they're growing revenues, they're opening new stores, they're doing well. They go to $20 of earnings, huge jump in earnings. The stock price has a huge jump to $500. But now the earnings yield, because of the way the stock is valued, the earnings yield is only 4%. It went from 10% to 4%, and now the 10-year Treasury there on the right is much more competitive. It's more attractive to buy a 10-year Treasury in some cases than a company at a 4% earnings yield that has risk. Here's year 5, and this is what's really interesting to see. You're going to see that stock re-rate. It's going to go down. We call it a correction. You see the stock sell off. And that's where I believe we are today with Microsoft, Google, Amazon, Meta, all of these SaaS apocalypse type companies. They're re-rating. And so even though their earnings are good in that first column, their stock prices have dropped. And in this case, the stock dropped from 500 to 350. That is a significant discount to where it was. However, when in doubt, zoom out. Go back to year 1. That stock was $100 5 years ago. Today it's $350. Yeah, it's not $500. It's not the record all-time high, but it's still $350. What are we complaining about? And that's where the S&P is today. I mean, you're telling me you bought the S&P in 2019 for $3,000. It's $7,300 or $7,400 a day. I know it's not $8,000. I know it's not $7,600. But you're mad about the S&P going from $3,000 to $7,300 in the course of 6 years? You're out of your mind. You're absolutely insane if you think that's bad. So you've got to have some context. You've got to have some reality. And I had people tell me literally every day, and I know this is the media driving this. I know for a fact. I know it's got to be the media because the data doesn't show it. Again, we went from 3,000 to 7,300 on the S&P in the course of 6 years. The only way you could think that everything's horrible right now and awful and the market's never been more volatile and it's never been more horrible than equities, the only way you could possibly think that is because you're watching too much TV and you're doom scrolling on Twitter too much. And so you got to get off that stuff. I've had people the past week or two say, oh, the market's been so volatile. It's been so, it was doing well and now it's not doing. What are you talking about is what I want to say. What are you looking at that I'm not looking at? The S&P was at 7,600 2 weeks ago. Now it's 7,300. Like take it easy, okay? It's going to be okay. That's not even a 5% pullback. And by the way, we could have a 10% pullback between now and the midterms. A 10% pullback is going to put the S&P back at 7,000 points. And you're not going to like it. It's not going to be fun. But remember where we were. We were at 3,000 in 2019. So have some perspective. Realize that even going from 3,000 to 7,600 back to 7,000 temporarily is okay. It's just part of owning equities. And if you sell, you're out of your mind. What should you really be doing is buying. And let's go back to our slide here for a second. Let's buy the stock at $350. Why wouldn't we? Fundamentally, the earnings have gone from $10 5 years ago in this case to $25. And here's what's really interesting. Because the stock is now dropped, it's just math, the earnings yield is now 7%, and the 10-year is going to start coming back. Remember, the 10-year is a market, and markets have cycles. And so just like the 10-year had a cycle of going up, now the 10-year has a cycle of going back down, and it's more attractive to buy that stock today than it was even a year ago, 2 years ago, and that's where these companies are today. I'm not saying they're dirt cheap. I'm not saying they can't get cheaper. I'm just telling you the math of how stock prices work. So the Fed is driving a lot of this. And if we talk about the wilderness years, I equate this to like the Israelites in the Old Testament wandering around in the wilderness. You know, they're on their journey. They're leaving Egypt and they're headed to the Promised Land. Well, before they can get to the Promised Land, they got to spend some time in the wilderness. They had to spend 40 years in the wilderness. And the wilderness isn't that bad. It's not horrible, but it's the wilderness. It's not the Promised Land. And you're eating manna and you're not too happy about the manna because you're like, well, it's not that great. And there's, birds all over trying to eat my manna that came out of the sky. And you're like, it's not horrible, but it's not the Promised Land. But here's the reality. You're on your way to the Promised Land. And that's the mistake the Israelites made. And so, you have to be careful. You don't want to be to the point where you complain too much in the wilderness because then you don't get to go into the Promised Land. And so that's what I equate the market to. Here's what's happened. And this is my analysis of where we've been the past couple years. 2021, we had a face ripper year, unbelievable, coming out of COVID. 2022 was not doom and gloom. It wasn't like you had to go back to Egypt, but you weren't getting to the Promised Land yet. You were in the wilderness. And I called it that. I told you we were in the wilderness. Now, 2023, face ripper, melt your face off, unbelievable year. Great. We got out of the wilderness for a while. It was a great year. 2024, face ripper year. 2025, face ripper year. What do you think 2026 is going to say? Maybe we're in the wilderness. And I don't know. I'm not going to classify this as the wilderness because going from 0% on the 10-year to 5.5% in the matter of 18 months is a massive, massive jump in interest rates. That'd be like the Fed going to like 20% today. That's not going to happen. But even if the Fed raises 0.5% or raises a quarter point or something like that, or at the least doesn't cut rates, we are going to maybe not be in the wilderness, but I've called it the jungle. And the jungle is a place where you've just got to be careful about what you're buying. We're in the jungle years, and you got to know what you have. You got to make sure you're not paying too much for stocks because that's how people get hurt in the jungle. They just don't know what they have. So you got to pull out your machete. You got to chop down a couple of trees, see what's in front of you before you just buy anything and everything. And so that's why we like the scalpel of going into the market and knowing what we own, knowing what the prices we paid for stocks instead of just owning the whole thing and hoping it works out. Because there was a time from 2000 to 2010 called the lost decade where equities did nothing for 10 years. You had the 1999 crash, the tech bubble at the beginning of the decade, and then you had 08 and 09 at the end of the decade, and investors made a total return of 1%, not per year, total across the entire 10 years. So that's why we have to be careful. It didn't happen to everybody, but it happened to people who weren't paying attention to the fact they were in the jungle. And so that's where I think we are for at least the next couple months. Now, let's just talk about the midterms for a second. This is very important to understand. Now, some of this is reading the tea leaves. We had no idea. We don't know. We don't have a crystal ball. But if you look back at history, this is from BlackRock. This is a great chart they put together. If you look back at history here and you look at the average market performance leading up, and this is trading days now before the election cycle, this is what happens to the market before the election up to day zero, that's the election, and then after the election. Now, we're about 130 days out. You'll notice that this chart starts at 126 days out from the midterms. So what you have to understand is I don't think, who knows for sure, but I don't think we've seen the worst of the volatility yet. I still think we've got a little chop ahead. We are still 130 days out from the election. You can see this on the chart here if I zoom in to this part on the left, that 126 days out, you're going to start seeing more volatility. In fact, you're going to see downward pressure on S&P prices. Historically, we don't know for sure what's going to happen, but historically, you've seen downward pressure still leading up to about 30 days out from the election. So that puts us sometime in October. Don't be surprised if the S&P ends up at 6,800 again or 7,000 temporarily, because here's what's coming. On average, after you get past the midterms, we end up with returns at double-digit levels. Look at these numbers. On average, S&P is up 14% after the midterm cycle. So if you think about the math here of buying the midterm dip, let's say we do dip to 7,000 and we get a 14% return off of that number, 7,000 with a 14% return gets you where? Gets you to about 8,000 points on the S&P. And that's exactly where I think the earnings support. Who knows for sure, but that's where I think we're headed. So let's talk about Ben Graham here. This is Warren Buffett's mentor, Ben Graham. Great quote. In the short run, stocks are a voting machine. That's the market. That's the day-to-day declines. The Fed is repricing. We've got interest rates. We've got Iran. We've got Liberation Day. That's a voting machine. But in the long run, stocks are a weighing machine. And what are stocks weighing? Well, we're weighing the merits of a company, the fundamentals of a business. And so all you do is you pay attention to revenue growth, you pay attention to earnings yields, you pay attention to earnings growth. And as long as you got great companies for a reasonable price, you're going to make it through anything that gets thrown at you. That bull market's still intact, the baby boomers, the millennials, the great wealth transfer, and the emerging market growth. And that's what's going to power the S&P higher. So as we get into the rest of the year, I think we're going to see some more volatility. Don't be alarmed when we see a pullback. Don't be alarmed if we see 6-7% off the S&P's price today. That's exactly what history would tell us. Would not be a surprise. However, when it's all said and done, here's where I think the earnings are in the S&P for next year, 2027. They're up record all-time highs. Pretty reasonable forward P of 20.5. And I think by the end of this year or early into next year, I think you're going to see about 8,000 points in the S&P, give or take 50 or 100 points. So why in the world would you panic today thinking that the sky is falling? And so again, if you go from 3,000 points in 2019 to 7,600 on the high end, like it was a couple weeks ago on the market, down to 7,000 temporarily, all you should be doing is buying. Because as we zoom out, as we fast forward a year, 2 years, 3 years, 4 years down the road, the S&P will, based on these valuations, be higher. And I've told you, I think S&P long run here is headed to 10,000 points. You can do the math on that, buying it at 7,300, 7,200, 7,100. Don't try and time it too much. Don't get fancy with it. If you've got a horizon of more than 2 years, 3 years, 4 years, 5 years, I think you're going to be in good shape. You may be thinking, Nick, I'm in retirement. I'm sitting here, I'm 65. Well, good. Hopefully you're not going to be gone in 2 or 3 years. Statistics would say, you could have 20 years, 25, 30 years to still be an investor. So what are you worried about? Even if the S&P re-rates 6%, 7%, 10%, as long as you've got money in a rainy day part of your portfolio, we like treasuries, 30-day treasuries, T-bills really, that pay some interest, that do not fluctuate when the market's down. As long as you got some safe money to keep you going through the bad times, you should be an optimist on the long run of the S&P. So this is where I think we're headed in the short run. I do think we're going to have some volatility. I think we're headed higher from there. Thank you so much for being on the show. We'll see you at Investor Day here in just a couple of months, and we'll see you next time. Thank you so much.